Thank you for joining me here for the state of housing. This should be a fun presentation because there's a lot of stuff going on. So welcome, welcome. I'm Kathy Fettke, co-founder of RealWealth. I do these updates, either every quarter or twice a year. Especially, I try to do them more often when things are confusing. So let's get started on the state of housing. And well, I always like to look at the bigger picture first, the US economy and what's going on, because obviously that will affect housing and all kinds of real estate. So, the big picture, as you know, is that the Federal Reserve's target for what they consider a balanced, healthy economy is this dual mandate that they have to keep core inflation right around 2%. I don't know why, but that kind of is the amount of inflation they feel kind of keeps us out of a recession, because basically it would be deflation, prices going down would sort of indicate a recession, and 2% inflation would represent kind of steady growth, but not too much. Unemployment, a little bit over 4% is what they consider healthy. Again, that would mean about 4% of the population isn't working or isn't able to find a job. They consider that healthy because if there is too many job openings, we had this just a few years ago, too many job openings and not enough people who want them, then we see inflation. It's a really tough balancing act. So if there's obviously not enough jobs for the people who want them, then we're headed into recession. So this target is what the Fed wants. Core inflation at around 2%, unemployment a little bit, like 4.2%, 4.3. And here we are today. If we were to take a snapshot of these two metrics in this moment, and in these moments, the next moment might be different from the moment just a moment ago. Inflation currently is close to the target at 2.3% for the first quarter. So right on target, really. It's right kind of where we were in the 2019 area pre-pandemic. So inflation's pretty good. And unemployment, look at this, we're right at that 4% target, a little bit over. And that thin line is wage growth. So we've actually seen some pretty strong wage growth. So if you were to just pause and not read any headlines and just kind of look at these two metrics, you would say that we're in a balanced economy. And yet, consumer sentiment says otherwise. This big line right here at the end, that is, you can see that's the share of consumers that expect unemployment to rise. So more and more people are believing, there is a recession coming. There's going to be job losses. And when you see consumer sentiment this high, it relates to you've seen that right before other recessions. So it's something to pay attention to. Why are consumers so concerned when actually in this moment the economy's doing okay? And it's uncertainty. In the Fed minutes that were just released last week, the word uncertainty was used like dozens of times throughout the speech. And that's really the sentiment that's out there. We're in kind of unprecedented times. The Trump administration is trying new things. Nobody really knows how it's going to end up. And that's caused confusion. Investors don't like uncertainty and confusion. The concern again is that of course, these tariffs would create higher inflation and unemployment, which is stagflation, which nobody likes. That's a dirty word in the economy. So policymakers said in the Fed notes that there was considerable uncertainty surrounding the evolution of trade policy and its impacts on the economy. As a result, we saw the GDP, the gross domestic product, down in Q1. It's after several quarters of robust growth. So this was a little shocking, but there wasn't a lot of concern about it because what it really seemed to reflect, you can see here in the quotes, the decrease in real GDP in the first quarter primarily reflected an increase on imports. So once again, this uncertainty of what are these tariffs going to do? We better buy all the goods we need now before prices go up. And that was a subtraction in the calculation of the GDP and a decrease in government spending. So it's hard to gauge, is this really something that's going to affect the economy? It's just that a lot of companies bought a lot of stuff before these tariffs would go into place. Now, like I said, investors don't like uncertainty. So we know that when Trump announced the big tariffs that he was going to do, Liberation Day, I think it was, we, of course, saw the stock market crash. That's the day I called my daughter and said, you better invest in the stock market because it's probably going to bounce back. And sure enough, it certainly did. But that was a reflection of the world, world investors not liking those tariffs, which was very much reflected in the bond market. But it has bounced back, so that's the good news. And just breaking news over the last 24 hours, stocks have climbed again after the court blocks some of Trump's tariffs. You probably saw the news, the ruling halts tariffs on China and other major U.S. trade partners. But this CNBC article came out and said there's a workaround. Section 122 of the Trade Act of 1974 doesn't require a formal investigation and could be a swift way to get around this court roadblock. So even though there's a stop now, Trump's, obviously going to try to find a workaround. But for now, the administration could, quickly replace the 10% across the board tariff with a similar tariff up to 15% under this Section 122. But it will still likely have to go through Congress because tariffs are a tax. Taxes have to be approved by Congress. So eventually, this is what's probably going to have to happen. Now, will Congress be on his side? We'll have yet to see. But again, it leads to more uncertainty. But at the same time, I do want to emphasize that all of this, to me, shows our government structure and the balance of our government working. The checks and balances appear to be working. There was so much fear by one party that we were losing democracy and that we were going to have a dictatorship and all these executive orders and so forth. But one thing that has emerged is that we do have a constitution. We have lots of lawyers. I think in California, there's like 18 lawsuits against Trump or something. I don't know. It's a lot. And the checks and balances are at play. So that, I believe, is giving some comfort to investors. And as a result, recession odds are dropping. JP Morgan research just reduced the probability of a U.S. and global recession from 60% to 40% as things start to play out. However, there's no certainty around that. So it could be subpar growth ahead until we have a little bit more clarity on where it's going to land with these tariffs. And as a result, the Fed is probably not expected to start easing, meaning cutting rates, until December, until the end of the year, at least according to JP Morgan, and possibly 3 cuts after that, eventually getting to 3.25%, 3.5% by end of next year. Nobody knows, but that's their prediction. And it may have something to do with what the Fed again said is they're just going to sit tight until there's less uncertainty. They want to see what happens, which means they're probably just going to keep rates where they are. All right, so how does all of this affect housing? Well, when there is uncertainty, generally bond investors would be buying bonds because bonds tended to be a safe haven for investors. And yet, because of all this uncertainty and all this change, that has not been the case. There was actually a sell-off of the bond market. As a result, if we don't have investors buying bonds, then bond prices have to go up, the yields go up, and that also affects mortgage rates. So a lot of people thought we would see mortgage rates coming down this year. It doesn't look that way. They hit 7% briefly, but have come back down. I think it's safe to say that we're going to be in the high 6s for a while. If we see massive inflation at some point, then we would probably see rates go up. So far, we haven't seen that. What we also know in the housing market is that affordability is at a 40-year low. Of course, if mortgage rates are up, that affects affordability. And this is just a very interesting chart showing that in 2019, so pre-pandemic, you had this percentage, much, much higher percentage of people in these different income brackets who could afford a home. You can see here the wealthy people are really unaffected by any of this. They're not too worried about any of it. They can still afford to buy a home. And pretty much in up in these higher brackets. It's really this group where we went from, 81% of people in the 150,000 range now down to 62%. People in the, $100,000 range, right, did I just do that? Yeah, from 64 to 37% can afford to buy a home. So it's really affecting sort of the middle class, people who are already strapped, trying to just buy groceries and live a normal life. It's really, really, really expensive and difficult to buy a home. And as a result, we're seeing first-time homebuyer age moving up to age 38. Now, normally, over the years, if you've been following me and watching these updates, you know that we typically say between 31, 32, sometimes 33 would be that average age of a first-time home buyer. And wow, has that really changed over the past couple of years to 38. So again, what does that mean if people are buying later? They're renting longer. It also means that because fewer people can afford to buy, there's more inventory. Inventory levels are up 30% from a year ago. And while headlines might really freak you out when you see that, when you look at the overall picture, it's still very much in line with where things have been in the past. This is us right now. Just the prior years, especially during COVID, we had barely any inventory. It was very, very low inventory, far too much demand, and that drove prices way up. So getting to this level of inventory is actually a very positive thing. It's kind of bringing us back to normal. We shouldn't see such low inventory that there's multiple offers and people having to make decisions within 24 hours, not being able to do inspections. All of that is bad for home prices going up too quickly and, again, creating this lack of affordability situation that we're seeing. Had there been more inventory over the past few years, we wouldn't really be where we are today, but here we are. So seeing this inventory level rise, I hope you'll be able to interpret those scary headlines and say, no, this is positive, this is good. We need more on the market. And that's kind of what buyers are saying. In spite of high rates and what's going on, pending sales were actually up in March. So the shocking thing in all of this is that home prices continue to rise. Defying gravity is why I put this picture here. It just doesn't make sense. Like how, when it's so unaffordable today, the least affordable in 40 years, how is it possible that prices continue to rise? Now, the price growth is slowing down. You can see the blue lines here are price changes from 23 to 24. So still too strong a job growth for buyers. It's just tough to have to buy a house that's now 10% more than what it was just the year before. But the orange line is 2024 to 2025. So you can see home prices still going up, but at a more sustainable pace. So again, you could look at this and say, well, this is a good thing. Now, homeowners, people who already own property, you've already made your money. So good on you. You made a bunch of money. But now we really need to focus on the home buyer, the person trying to get in the market. So this slowdown in price growth is good for them. It's healthier. Over the last year, there were some surprising winners, areas that went up the values went up far past the median. You can see New York, this was very surprising to me, but values almost double of what they were nationally. prices going up. Chicago also, that surprised me. Cleveland didn't surprise me so much. It's one of our hot markets at Real Wealth, and we know the kind of growth that's happening there. So not surprised that it was almost double the national average. Boston, Detroit, look at that. So there seems to be kind of a flip, because down here at the bottom, the markets that were the hottest during the pandemic are the ones seeing a slowdown. And the ones getting hit the hardest, the Tampa area, just down 1.5%. So we're not talking about any kind of housing crash at all. But Tampa, in some years, I think values went up 20% just in 1 year. So a pause in Tampa is a good thing, again, to let wages catch up with how high home prices went in the Tampa area. Now, interestingly enough, I was going to put a slide in there, but I didn't. We have a development that we syndicated in 2014. It's called the Murata. It's a beautiful, beautiful subdivision just about 45 minutes north of Tampa. And we hit the top 8 subdivisions in the country for sales. It's been hundreds, and I think it was we hit. Oh, I should have put the slide up there, but we are having record number of sales. So that's just 45 minutes out of Tampa. So when you see cities like this, you have to remember that's the city they're talking about. That's not necessarily the metro area. The metro area is growing. Maybe people don't want to be in Tampa anymore. It's too close to the hurricane, so they're moving inland. Whatever it is, our project, the Murata, is having record sales. And like I said, I believe it was number 8 in the country of subdivisions selling the fastest. So again, keep in mind, there's a balancing happening, and there just seems to be a shift. Also, some of these areas, Dallas, Denver, Tampa, there was a lot of development. Phoenix, you have a lot of new supply that came online into these areas, and that has to be worked through as well. But the biggest thing to pay attention to is, how could there be price growth, with prices being up already, things being so unaffordable, mortgage rates being so high. And it really comes down to this: the existing home sales are so low. Normally, we would be much higher than this. I think during the pandemic, there was like 6 million homes trading. Now it's down to 4 million. That's down a third, right? So when you see any movement in sales, the numbers look huge because the number of sales are so low anyway. So if you start to see an uptick or less sales, you're talking about a much lower number of sales overall. So any data you see is going to be really dramatic. So again, keep that in mind, that home sales, just the movement of homes, people buying and selling homes, is at some of the lowest we've seen in history. You'll also hear that delinquency rates are up, that there's high debt. I think it was 18 trillion or something of consumer debt. And some delinquencies are up, like credit cards. You can see that. Student loans are up. Auto loans trending up. But look at this golden line. That's mortgages. You are not seeing much movement there in delinquency rates in mortgages. Now, why would that be? Because that's a bigger debt, right? Well, also, we're seeing foreclosure starts are low as a result. People are not defaulting on their mortgages in a very high percentage. Why? What does all that mean? Well, the bottom line is U.S. homeowners are strong. They're in a very strong position. I've shown these slides before, but I'm going to show them again. Good credit. The people who own homes today have fantastic credit. This blue line, it's 760 credit scores. So that's the majority of people who own homes today pay their bills. They have a history of paying their bills, versus back in the housing crisis, we had this big blue line down here that was subprime. Those are people who don't pay their bills that were getting mortgages, and guess what? Didn't pay them. So the credit profile of people who own homes today, ever since Dodd-Frank, and I believe it was 2012, came out with the qualified mortgage requirements, meaning that you actually have to qualify for a mortgage. You can't lie on your application or not show what you actually earn or what your actual debts are. It's you have to show everything to get a loan today. And so people who have loans are really good borrowers, and they're locked into extremely low payments, historically low payments. 89% of homeowners today have mortgages under 6%, with a huge majority in the 2, 3, 4% range, really below that. So their payments, the people who own homes today, the majority of them are in extremely low payments. And therefore, they're staying longer. And that's why this housing market is still kind of stuck. There's more coming online, but for the most part, people aren't moving. And then you've got this stat, 40% have no mortgage at all. So if they want to sell a house and buy a new one, no big deal. You just sell it, you take your cash, you buy another one. They're not worried about interest rates. And they're swimming in equity. Since 2012, we have only really pretty much seen values go up, equity go up, and it's tough to, let's say you did lose a job, but you have all this equity, you might just put your house on the market. That's why the foreclosure rate is so low. Just put your house on the market. You can lower the price a little bit if you need to sell it, because there's so much cushion there. So again, that's why we're just not seeing a foreclosure crisis or a housing crash of any kind. Asset holders are rich. They're sitting on 1.3 trillion in equity at a minimum. So that's the current homeowner. What about renters? Where are they today? Well, again, we've got this large demographic. This is about 33, 34 years old right here. Remember, I said the first-time home buyer age is now 38. So you've got this massive group that is forced to rent because of the situation right now. If they're forced to rent for probably 4 more years, what does that say for the rental market? We also know that 18 homes are needed by 2034, but not just any home. These need to be affordable homes. John Burns is expecting 13 million households to be formed over the next 9 years, 500,000 new second homes. There'd be about, homes get old, so about 2.3 million teardowns, and we're already at 1.5 million undersupplied homes. So there's a need still for new housing, but it's not what's being built. It's the affordable homes that need to be built. There's a lot of companies trying to solve this crisis. The government's trying to solve this crisis, but at the end of the day, you just can't build affordable housing. So it's really hard to bring it online. Nobody wants to build at a loss. And I can say that from personal experience. We have a development in Park City where we were required to build 30% of it affordable, meaning that the average salary of the area has to be able to afford it, which would be the teachers, the firefighters, and so forth. So we were locked in and required to build affordable housing at under $400,000 in Park City. It costs us $800,000 to $1 million to build those affordable housing. So the county's asking us to take the hit to provide it. And that's pretty typical and common. So who's going to do that? Who's going to bring on a bunch of affordable housing and lose money? It's very, very difficult. So if we can do it as investors, if we can work with builders who can still build at affordable pricing, if we can work with companies nationwide, or like our rental fund in Dallas, where we're buying old houses that no first-time home buyer could buy because they don't have the money to fix it up. They don't have kitchens. They don't function, we can go in, buy those cheap, fix them up, and provide that affordable housing that's so needed. Investors are really the key to solving this problem. We're also seeing household size shrink, and then single-person households grow. So the more single-person households out there, the more housing inventory we're going to need. We also know that, who knows, John Burns says 3.8 million extra people in the country from immigration over what we would normally have. Some people say it's much, much more than that. Of course, the administration has been going after people who entered the country illegally, but from the reports I've seen, it's not really making a dent, into this huge pool of people that came into the country who also need housing. So POV, the point of view for investors, to sum it all up, what does that mean for you and me? A lot of people compare stocks to real estate, and I get it. The stock market's done amazing and somehow rebounded after all this craziness and all this uncertainty. It's rebounded. It's again also defied gravity. So a lot of people say, well, it's easier. Warren Buffett came out with an article saying stocks are the play. Why would you do real estate? Real estate's hard. There's expenses. And when you're looking at it from a slide like this, I would 100% agree. Why would you do real estate when you could go just put your money in the stock market and make overnight gains doing nothing? Massive gains. But in all of these comparisons, what people are looking at is the value of the stock going up versus the value of the house going up. So the value of a house going up, even though they've gone up a lot, it's let's say it's 10%. 10% of $200,000 house is $20,000. If you put $200,000 in the stock market, would you make more than that? It looks like you would have. But the difference is very few of us are putting $200,000 down to buy a house. We are leveraging. We're putting on a $200,000 house, $40,000 down. So if we're putting $40,000 down and the house goes up 10%, let's just say, I'm just using easy math, and that's a $20,000 gain in 1 year, but we put $40,000 cash into it, we just made a pretty darn good return. I don't think you can compare that to anything because, again, of leverage, because banks are so comfortable lending to you in ways that they won't lend to business or stocks or anything else, just to real estate. You only have to put 20% down. So you're going to maximize your equity growth by using leverage like that. Very important metric, again, that too often is overlooked. In addition to that, so on this chart, this is the reason why you're here. This is the reason why Real Wealth is here, because we're talking about things that you're not going to see in the headlines, because the headlines aren't speaking to us. Who funds the headlines? It's either going to be the stock market, or they're not talking to investors. They're maybe talking to home buyers who want to buy their residential home, but they're almost never talking it to you and me. So we have to interpret the headlines our way, from our point of view. So as I said, I just touched on the values increasing over time, but what we used was leverage. So we have 5x'd, because we're putting 20% down, the actual return. If we're putting down $40,000 and getting $20,000 in equity growth, that's incredible. That's very different than getting $20,000 from a $200,000 investment. In addition, what is not mentioned in any of these comparisons is the cash flow you get from the property, the tax benefits you get, the asset protection, and again, just the tax benefits. Oh, and I don't have it on here. The loan pay down. So somebody else is paying off this leverage for you. Wow, I need to add that slide on there. The loan pay down, which I suppose would go in leverage because somebody else is paying off your debt for you. Somebody's giving you the money to buy the asset. Someone else is paying off that debt for you. You just can't do an apples to apples comparison between real estate and stocks. And that's why I really I'm going to go back to that slide, but let me ask you, if you were to do what your financial planner says and put a certain amount of money into the stock market every year, how long would it take for you to be a multimillionaire? Now, talk to real estate investors and find out how quickly they became multimillionaires. We have these stories on the Real Wealth Show all the time. It's a much faster accelerator of wealth because of all these factors that just other investments don't have. And then I'll add finally the financial engineering. that our government has gotten very addicted to, which is if we have a financial problem, we will just make more money. This wasn't a normal thing in the generations that my parents lived in the 60s, the 70s. The government was not allowed to print money. That was a big no-no, and it would make headline news. I remember my dad being very upset when a few $1 billion was printed. We just had to balance budgets. That's how it was back then. Well, as you can see, there was a little taste of money that happened in 2008 when we had a major financial crisis. And the way to solve that was to print trillions of dollars. And boy, did we get addicted to that as a country. Because when you find out you can just print money, why do you worry so much about things about like debt and costs of things? You don't have to balance a budget, which we've seen. Again, another breaking news story, Elon Musk is out. He's like, regardless of how you feel about him, I'm just going to say this. He was very passionate about cutting expenses. And then the big, beautiful bill came out and he said, well, what am I doing this for? Because that's more spending and I'm trying to cut spending and it's a waste of my time, basically. So that's at least what he stated. Who knows? That was the current news. Like how are we ever going to balance a budget when we've seen what's happened over the last few months? People get very angry, very angry. I do drive a Tesla, not for political reasons, but I just think it's a great car. Actually, it's a hand-me-down from my husband who actually loves the car. And boy, did I feel a lot of hate driving around in this car. And so it's like, trying to cut the budget it's tough. It's really tough. Nobody wants to do that or see that, not the people who are getting the money. So as a result, we have become very much addicted to this financial engineering and just printing more money. And what that tends to do is raise asset values. That's what we've seen over the years. So again, just want to show you these shocking charts of how our money supply expanded as a result. And again, when you throw more money into the monopoly game and there's only a few apartments and houses on the board, but you got all this more money chasing it, that's how asset values rise. So going back to 2005, the Real Wealth show, I had just kind of started it, I guess, 2004, and I had Robert Kiyosaki. I know a lot of people have already heard this story, but I'm going to say it again because I think it's important in times where it's confusing and crazy and people don't know what to do. I just want to come back to the thing that has worked through lots of crazy over the years. Like, what is the rudder? What's the thing that you can just kind of lay back and not worry so much? Like again, people worrying so much that we're going to lose our democracy. And here we are, like our democracy is working, right? We've got a system that works. We don't have to worry so much. So what's the thing that we can just like rely on in investing to? And I come back to these metrics every time, and it's worked every time there's been something crazy. And let me tell you, I've been doing this long enough to tell you there's a lot of things. I've been through the 2008 crash. We figured COVID out, and it always came back to these basics. So these are my fundamentals for investing. It's the fundamentals of real wealth, and it's how we've been able to help investors become multimillionaires just following these simple steps. Because no matter what is going on there, if you just look here, you can pull yourself up, make decisions that other people are too scared to do, and win. So investing in areas with job growth, just because you're seeing potential job losses, that's important to understand, but look for where the job growth is going. There's always been areas where jobs are leaving and jobs are going, regardless of what's going on in the bigger economy. Where are jobs going? Just focus there. Population growth, where are people going as a result of that? And where are cities investing in themselves? Because when cities invest in themselves, they have 10, 20, 30, 40-year plans. And they're not going to just change those plans overnight. They're going to invest. When they invest in freeways and airports, they have done massive studies. Those are just little crumbs on the path to tell you that you're on the right direction when you see those kinds of infrastructure growth. And then when you can add this fourth component of affordability. So, for example, New York City, sure, prices went up. I'm never buying there. They could have all the job growth, all the population growth, and all the infrastructure growth in the world, and I will not be an investor in New York City because it's not affordable. It's the same as San Francisco. Born and raised in well, not born in San Francisco, went to school in San Francisco. My grandma was born in San Francisco. It's changed a lot. One thing I know, you can make money there, but oh boy, you're going to probably take a loss on cash flow. It is not affordable. Although I just did talk to somebody there who said you could buy condos in San Francisco for 2014 prices. So it's more affordable than it's been. If you want a condo in San Francisco, now would be the time to buy. But as an investor, a buy and hold investor, doesn't make sense. What did make sense in 2005, and I want to take you back there because this was another time of confusion. This was a time when prices were going up 40% every year in 2004, 2005. People were jumping into the market saying, well, I want some of that, thinking that that was going to continue. It never does. Don't get caught up in that kind of hype. Texas was not having that. In fact, Texas was 27% undervalued. This beautiful house was $145,000 in 2005 when the rest of the country, prices were ballooning. And yet it had the highest job growth and population growth in the country. It was not a hot market. It never made the hot market lists. When I started investing there, people would laugh at me. They would say, oh, nothing happens in Texas. Oh, you're new to the business. You'll figure it out. And they were wrong. I was right because I followed these basic fundamentals. Now Texas is hot. Now people know, but prices are already up. You have to kind of get in before people know. But the nice thing about Texas is there are areas outside of Dallas that are booming. Dallas proper has become expensive. It wasn't when I started investing. We were investing all in this area, the inner part of the Dallas area. And it was cheap, but it's expensive now. And so you got to keep moving on out, following where the jobs are going, where the population is going. So when we talk about Dallas, we're not really talking about Dallas proper. We're talking about the areas around it where employers are also saying, I don't want to be in the expensive metro area. I want to be in, the growth areas. So this is an example of some properties that were, I believe, recently purchased or now available from our team in the Texas area, who has consistently led us into the path of progress, where I would go with her on car rides and say, you cannot be serious. We're not coming out here into hayfields, which was what all this was. I mean, this was when we were investing in this area, it was just fields, now it's cities. And so they just keep taking us out to where I'm like, this, you can't, there's no way. But it just keeps growing into the suburbs because that's where it's affordable. That's where the jobs are going because employers like affordable areas for their own businesses as well. Anyway, this is 20 years later. You can buy a duplex for $385,000. Like I said, we were buying stuff for around $150,000 for a single family. Today, 20 years later, you can get a duplex for $385,000. That's incredible. So there's opportunity still out there. You just have to know where to look and follow those fundamentals. And then look at the fine line. Like, never look at year one to decide if you're going to do a long-term investment. What you have to look at is all the other factors there. You're a busy tech person in San Francisco working 60-hour weeks. How are you going to go out to Texas, like what we did with our fund, find an older home, fix it up, build in all this equity, deal with repairs that are needed over time because it's an older property? You don't have time for that. If you're a doctor, you're a nurse, you don't have time for any of that. So if you're thinking long-term, you already have a job. You don't need cash flow right now. What you want is to be able to retire comfortably sooner than later. then you want to be looking at a 5-year or a 10-year, 15-year, 20-year plan, whatever it is, depending on your age, when you want that financial freedom. It's not going to happen overnight unless you already have the money. If you inherit money, if you own a home and you want to sell it, we see this all the time. Somebody had a $4 million house in the Bay Area, free and clear. They want to sell it. Yes, you can cash flow with $4 million. I guarantee you, we will help you cash flow and retire today through all the teams that we have around the country. But if you do not have that $4 million cash, you need to get there. You need to build it. And it doesn't happen overnight. I hate to break it to you. It happens over time. And over time, I mean 10 to 15 years. You can do that. That's still good. So when you look at year 10, this is the number you want to be looking at. What is this property going to be worth when I need it to take care of me? When I need it to grow equity. And the way you're going to grow that equity with a more passive investment, because you're busy, you don't have time to go fix things, then you need it to be in the path of progress, hopefully a newer property that's not always breaking down on you and eating up your cash flow. So looking at this number, year 10, how is my portfolio going to get to a point where now I can cash flow and have that beautiful retirement I'm thinking of? So where are some of the areas today where you can still find those deals, still follow those fundamentals? Like I said, North Dallas for sure, still hot. Oklahoma is an area that I always wanted to have a great team in. I wanted to be able to present that to investors, but we just didn't have one. Now we do. And I'm excited because Oklahoma has so much going for it, including talk of becoming more like Texas, having no state income tax and really growing the way that Texas has because it borders it. Oklahoma is doing a great job at that, ranks 9th in job creation across the U.S. already. And that's over the past 5 years. And a new deal coming in with the UAE company to build $4 billion in aluminum smelting facility. So if you're going to reshore or onshore because of your fear of tariffs, are you going to go to San Francisco or New York? No, you're going to go to an area that's affordable and to build your factories and to bring all this onshoring. And so that is, kind of what we're seeing in these markets. There's great opportunity. Our team that is now in Oklahoma, this is some of what they're showing. Duplex for $432,000, rents for $3,000. And again, year 10, what is this new duplex going to be worth when you need it, which is, again, to build that equity growth by paying down the loan and also being in an area with the path of progress. Alabama is a major hub for basically offshoring from Detroit. So Detroit got very expensive for car companies because of course, we know because of the unions. So a lot of those car companies, instead of going to China, just went south to the south where maybe there weren't as many unions to, make labor more expensive. So Alabama has become a major hub for the auto industry. And again, because of the concerns about tariffs, more business coming in. Hyundai launches tariffs task force, shifts production of popular SUV to U.S. to avoid those taxes. Mercedes details plans for U.S. production in Alabama. And it just so happens we have a fabulous team in Alabama getting ahead of all this growth. This is a property that just literally came in today, to give you an idea of a newer home, a set and forget kind of home. $290,000 with an estimated rent of $2,100. That's incredible, just incredible in this path of progress area. And again, you want to be looking at the year 10. How is this going to be affecting me when I need it? Indianapolis, another super hot market right now, probably one of the hottest. We've liked Indianapolis for a long time for a lot of reasons, but boy, oh boy, is it getting a lot of attention right now. Ranking as one of the nation's hottest housing markets in 2025 by Zillow and by the National Association of Realtors. Why is that? Affordability and job growth. It just, again, fundamentals. The Metro's job growth rate of 9.3% from October 2019 to October of 2024, nearly twice the U.S. average according to NAR, and again here, relative affordability. So businesses like to be in areas that are affordable. It's affordable for them because they can technically pay their employees lower wages than if they were in New York or San Francisco. Their employees can live better because their cost of living is lower. Again, it's a major hub for the pharmaceutical company. There's a lot going on in Indy. There's, a tech hub. There's quite strong diversification, but definitely a biotech pharmaceutical hub. And you probably saw the news that Swiss pharmaceutical companies are announcing, well, at least Roche announcing $50 billion in investment over the next 5 years. Generally, companies like to be near other companies of the same breed, so to speak. So New York and San Francisco are starting to grow again because of AI. That's why we're seeing so much growth in those areas. The tech industry has gone all over the country, but AI is now about to boom. And so companies that want to be at the forefront of that want to be in the center. So New York, San Francisco for that. But Indy is the biotech pharmaceutical, and as we know, lots of reshoring there. Very exciting for that area. And our team there is wonderful. If you haven't met them at our events, you should. We've known them for years. They're just really good, solid, good people. And here's some samples of what they have. Again, we want to be looking at the year 10 purchase price of $499 and gross rent $3,500. Chattanooga has been all over the news. I never really heard of it until recently, but they're having a surge in business too. A huge boost with over 73,000 new business entities filing in 2024. I don't know why this area has hit the map so hard, but we just have a great team. Actually, a neighbor came over and was like, I heard what you do. I want to invest. They chose Chattanooga. They're really happy there. So if you can just ignore all the noise and get back to the basics of why you're here, why you want to invest, what your ultimate goal is, how do you reach that goal, you will find it regardless of what's going on in the news. Just follow those 4 fundamentals, speak with one of our investment counselors, read my book. I'm sure hopefully you listen to the podcast to stay updated, and hopefully it's not too confusing because I do spend a lot of time on the macroeconomics, and that can be confusing. I should probably spend a little more time on the fundamentals to understand how you can maneuver through all the chaos to still build your dreams and your portfolio. Okay. Almost done. I think we've got time for questions. So someone said appeals court ruling against Trump tariffs. Yep, I said that earlier. And he's got a workaround. He's obviously going to fight this, but at the end of the day, it's going to need to go through Congress. And that's why it was stopped. It's like you can't, the Constitution's very clear that if you're going to increase taxes, our country was founded on not liking taxes. So if you're going to raise taxes, it generally has to go through Congress. Trump used a workaround on that, but it looks like this appeals court is going to require that. So will it? That's part of the uncertainty. We don't know what Congress is going to decide. Are they going to vote for it or against it? We don't know. So that brings us back to the uncertainty. And again, investors don't love that. Next question, how do you see the current discussion to privatize Fannie and Freddie impacting the residential investment market? I'll do some interviews on the RealWealth show. I don't want to speak to that because I just don't know enough. But what I do know is that mortgages have been subsidized by the government for decades. And I think the government is very aware that the housing market is a huge driver. Real estate is a huge driver of the economy. So that's why they subsidize. They don't do it just because they're nice. So I don't know how this will go, but I've heard talk that we would see mortgages go up, if it's not privatized. But there were many years when it wasn't and housing was still booming, So let's bring on an expert to the RealWealth show. What about the market in Florida? Like I said, Florida's getting a lot of flack, but again, you've got to read the headlines. From the POV, the point of view of an investor, is Florida going out of style? Do people not want to live there? I think there's a lot of migration shifts happening. There was certainly migration shift to Florida and the Southeast during the pandemic and the decade leading up to that. What is the shift now? The shift seems to be affordability. People saying, would love to live in Florida, but I can't afford to. So guess what? They're going to go where they can. This is what, again, fundamentals. So if you can afford to live in Florida, great. People still want to move there. I just talked to somebody who's moving there. Beaches, beautiful weather, people like it. However, if you can't afford that and you can't afford California, you're going to go somewhere where you can. And it's the markets that I just said, the markets that are affordable, have job growth, infrastructure growth. The Midwest is really kind of hot right now because it's more affordable than other places. So coming back to Florida, is it a good place to invest? A lot of the news we see is for buying, but what about for renting? What about, do people still want to live there? They can't afford to buy, but they have to rent. Certainly. So right now, because there's high inventory in Florida, I personally see it as a great time to invest because you can negotiate. You can demand lower prices. You can look at the comps and say, you're off on your pricing. This is what the going rate is. I want this rate. And get into a market that still is quite desirable. And the only reason, it wouldn't be as affordability. So if you can make it affordable for a tenant, I'm still a fan. And we haven't really seen personally insurance rates wipe out our cash flow. It's gone up a little, but we're still, our properties in Florida are doing great, and I've kind of heard that from other people as well. So hopefully they'll figure out the insurance thing. As I understand it, there was a lot of fraud. I just did a RealWealth show on it. There was a lot of kind of insurance fraud in Florida. So hopefully they're going to sort of shore that up and fix that problem there. Let's see. Hey, Brenda. Thank you. And yes, Chattanooga is great because it's a major transport hub. Okay, left that out. Thank you. Yeah, it's just booming. I mean, that's a great market to look at, and our team there, we've had just fantastic reviews. Question, do I have to come up with a higher down payment for financing a duplex? Talk to a lender, but it's 1 to 4 units are kind of treated the same. So once you get over 5 units, then we're talking commercial loans and it's different. So, generally 25% down, regardless of whether it's a duplex or a fourplex or single. But again, talk to a lender. Question, would you think Florida and Texas will be able to absorb excess inventory in the next 1 or 2 years? And will the population migration continue over the years? Yeah. Yeah, that I've had a few economists on saying this is kind of how things go. When there's huge demographic shifts, builders jump in, builders really dove into the Southeast. So there was a lot of building happening in Florida and Texas, and yet there is this massive migration and growth, but it has to balance out. So right now, builders are saying, yikes, I don't want to build anymore because we've got to get through the inventory we have. And it takes so long to build that we're going to go probably through another cycle of, okay, now all the inventory's gone and builders stop building. So what does that mean? These are areas that have been attractive for economic reasons. There's no state income tax. Obviously, the weather in Florida is great. We had a lot of companies move to Florida and Texas because of their laws. So I just think it's a matter of working through the inventory and then getting into those submarkets that are hot. Because like I said, I should have showed the slide, but you can't just blanket say Florida is oversupplied. Certain parts 100% are where there was overbuilding. But like I said, we have our project. You should look it up. The Mirada in oh my goodness, what am I forgetting the name of the city? But anyway, it's north of Tampa, the Mirada, and we have had unbelievable sales, like 400 sales this year. Like it's crazy how many homes are sold. There's like 4,400 lots in that subdivision, so it's massive. But that's right outside of Tampa, about, like I said, 45 minutes, and selling like crazy. I mean, it's got incredible amenities, so I understand why. But at a time when there's oversupply, you want the best product, right? Our product there is fabulous. It's got a crystal lagoon. It's like really super family friendly. So it's moving, whereas maybe other subdivisions, not as much. So, yep, I'm still a fan of Florida and Texas, and even probably more so because now if there's excess inventory, you can strike that deal. And so that would make it a better time to buy than it might have been. Next question, you mentioned credit scores at strong levels. I've heard that it's possible that the credit criteria has been or maybe lowered to keep scores artificially high. I think it's been really hard to get a loan, so I would really strongly doubt that that's true. You've got the qualified mortgage that, the borrower's got to meet the metrics. So I haven't heard that, and I know how hard it is to get a loan, so I kind of doubt that's true. But there's always mortgage lenders who cheat, so there's probably some out there. Let's see. President Trump has talked about limiting Section 8 to a couple of years. How do you see this playing out with those of us that have a decent portion of our portfolio in Section 8? He's talking about shifting the burden to the states, but the states don't have the funds. Yeah, I saw this and I was curious what his rights are. But remember, we have 3.5 years, left. So things go back and forth. And that tends to happen when you have an extreme Republican, then flips and you get an extreme Democrat. It's just kind of been more and more of that. So it could change, but then it could change again. So I'm not educated enough to answer that, but I would never want to be overinvested in any one asset class. So I'd be maybe concerned. I don't want to say concerned, but if all of your properties are Section 8, you might want to look at that and diversify a little bit, just because we don't know. But my guess is he's not going to maybe be able to do it, but who knows? Appeals court temporarily reinstates Trump tariffs above, just flashed on my screen. Yep, I knew Trump was going to appeal it, but it does seem like eventually he's going to have it go through Congress. We shall see. This is one of those times that we really, just like I said, uncertainty, nobody knows. Nobody knows. And that's why it's like, it's a lot of noise out there. So when you just dial in on the fundamentals, it really helps with clarity. Someone says San Antonio is near the Mirada. No, San Antonio. Yeah, is it San Antonio in Florida? Yeah. So not San Antonio, Texas, but yeah. It's a beautiful development. Check it out. I asked them, we syndicated it. So I was like, can't we sell some of these homes to our members? And I think we should have, but basically our business plan was to acquire the land, entitle it, and then sell to builders. So we aren't the actual builder. We are just selling, big groups of lots to builders, and then they control it. So we haven't been able to do that. But if you want to buy in the Mirada, I think it's a great deal, although it's probably a little bit expensive at this point. Okay, next question. I think the impact of layoffs may take time to hit housing because human nature is to go into denial and stretch all options, but then it's a free-for-all. So how should investors plan for a possible down market? Yeah, like I said, nobody knows. Right now the job market looks great. Could that change? Of course it could. I don't think that's what our current administration wants to see, and I believe that they would correct it if that were to happen. If that were to happen and we started to see job losses, then the Fed would react and probably cut rates, which then we'd see mortgage rates come down. So in that scenario, if we saw some job losses and we saw rates go down, I still believe that there are enough people who wouldn't be affected because, like I said, the market's kind of stuck and the number of sales is so low anyway, that if rates went down, I think there's still enough people that would be like, yeah, rates are down, I can afford to buy now. So that's that kind of weird place that we're in, unless it was just a major, major recession where lots and lots of jobs were lost. That would affect the housing market. But otherwise, there's just too many people with low payments, 40% who own the home free and clear. I am just not worried about the housing market crashing. Now, are there areas where prices have gone down substantially? Absolutely. Austin is one of them. Some people say they've gone down as much as 20% in Austin. That's not been one of our markets because we have great advice from our team there who kind of saw the writing on the wall. Just kind of that's why we're focused on Dallas, because there's so much diversity in employment there. Okay. Should I stop looking for 1% properties? I'm assuming that you mean the rent comes in at 1% of the purchase price. It just depends on what you're trying to do. If you're going to get the 1% rule, and I did write about that in my first book, but then I updated it. So read the updated version of my book because I changed that. If you're going to get the 1% rule, it's probably because you bought a cheaper house, you bought an older property, and it's probably not going to appreciate that much over time. Or you bought an older property like we did with our Dallas, Texas fund. We bought older properties in growth markets and made them like new. And it definitely came in over the 1%. So, but again, you're probably buying older. So for those of us who just are so busy, you don't have time to go find an older property, get it fixed up, build that equity in. It's hard to do when you have a full-time job. So if you have a good job and that's your focus, just get something easy, get something newer in a growth market where you can set and forget. I mean, you should never forget what's going on. You always pay attention to your portfolio, but you won't have to worry about it so much when it's newer. And the newer ones are not going to come in at that 1%. So just depending on what you're trying to do, do you need the cash flow today? Maybe you want to look for that 1%, but most people are trying to build wealth, and I don't think you're going to do it that way. If you're trying to build wealth, you might have to just take a hit on cash flow today and really focus on the future. Is this an area that's going to be strong in 10 years? That's the metric to look at. Is this an area where if my tenant pays off my debt for me and the area sees values rise, I'm going to have this double whammy of equity value going off and loan pay down happening while I'm getting the tax benefits. So, like I said, if you have that $4 million house in the Bay Area paid off, you want to sell and you want to go retire today and live on cash flow, then maybe you want to look at the 1%. But for the rest of us, I don't think that's the play right now. Is there a big advantage to cash buyers now? Builders are offering rate buydowns for finance deals. The only time I think it's good to pay cash is if you're going to do what we did in the fund, where we used cash to negotiate really sweet deals, and then we use the cash to fix up the properties, and then you refi and you get all your money back out. Because the way you truly build wealth in real estate is through leverage. So if you're, like I said, if you own a property that's $200,000 and it goes up 10%, you haven't made, you made an okay return, but you've made really a great return if you only put $40,000 in that property and made a $20,000 return. So leverage to me is the key. But as far as getting the deal, sure. If you come in with a strong deal or a strong offer and say, you see an area that's oversupplied and you say, I can come in and close, I've got the cash, you don't have to worry about me getting a loan. But in exchange, I want a discount. Great, do that. And then hopefully refi later to get your money back out and go do it again. Okay, that is it on the questions. Appreciate you being here. And we've got the most wonderful investment counselors at Real Wealth, experienced. They are there, ready and waiting to answer your questions. I go to them for advice. Our team goes to them for advice. I just did a Real Wealth show with Celia, who actually puts on these webinars, and she said, uh, she said what I go to our investment counselors all the time because they help me through things that are scary. It's scary. We shouldn't be doing this alone. We are a network. We are here for you. Don't feel like you're alone. We can't control a lot of things, but we can control some things. So we want to hear from you. And literally, we have leadership meetings every week where our investment counselors are excited about the conversations they're having with you. They're inspired, and so just know that you can reach out. You're not on your own. Okay, thanks everyone. Take care. Have a wonderful day and hope to see you soon.